In the fast-evolving landscape of investment opportunities, the debate between investing in cryptocurrencies and traditional stock markets has gained significant traction. This video will delve into the reasons why choosing crypto over stocks might be advantageous, catering to investors seeking comprehensive insights into this intriguing dilemma. So without further ado, let's dive into the video and subscribe to the channel. Cryptocurrency has taken the world by storm, especially during the last few years. After having peaked around $3 trillion in 2021, the total value of all these digital currencies sits at about $1 trillion, according to CoinMarketCap.com. Of these, Bitcoin is the most popular, worth more than $400 billion itself. Investors have swarmed to this digital gold rush, often with little knowledge and a lot of hope. Cryptocurrency's rapid appreciation has many investors questioning the place of stocks in their portfolios. But there are numerous differences between stocks and cryptocurrencies. The most important is that a stock is an ownership interest in a business, backed by the company's assets and cash flow, whereas cryptocurrency, in most cases, is not backed by anything at all. If you're buying cryptocurrencies, it's important to understand what you're purchasing and how they compare to traditional investments such as stocks, which have a solid long-term track record. Should you invest in cryptocurrency or stocks? Any savvy investor needs to know exactly what they're investing in. It's crucial to weigh the risks and rewards of investing and what will drive the investment's success. If they don't have this kind of information, they can't make the calculation. In this case, it's not really investing. It's much more like gambling. Here are the key things investors need to know about stocks and cryptocurrency. Stocks. A stock is a fractional ownership interest in a business. It's easy to lose sight of this if you become overwhelmed by the wiggling stock prices and the potential for profit. As a legal ownership stake in the business, the stock gives shareholders a claim on the assets and cash flow of the business. These back your investment and provide a basis for its valuation. Why stocks rise and fall? A stock price moves as investors assess the future success of the company. While investors may become overly optimistic about the stock in the short term, the stock price ultimately depends on the company's ability to grow its profits over the long term. That is, a stock rises in the long term due to the success of the underlying company. For a stock to be a successful investment, the underlying company must perform well over time. Here's a step-by-step guide for how to invest in stocks. Cryptocurrency. Generally, cryptocurrency is backed by no hard assets, specialized stablecoins being an exception. And that's the case for the most popular crypto coins such as Bitcoin and Ethereum. A cryptocurrency may allow you to perform certain functions, such as sending money to another person or using smart contracts that automatically execute after specific conditions are met. Why cryptocurrency rises and falls? Because cryptocurrency is not backed by assets or cash flow. The only thing moving crypto prices is speculation driven by sentiment. As sentiment changes, prices shift, sometimes drastically. So cryptocurrency is driven only by the hope that someone will buy it for more in the future. What's called the greater fool theory of investing. For a cryptocurrency to be a successful investment, you must get someone to buy it from you for more than you paid for it. That is, the market must be more optimistic about it than you are. Pros and cons of investing in cryptocurrency versus stocks. Pros of investing in cryptocurrency. Possible hedge against fiat currency. For some investors, one of the biggest appeals of cryptocurrency is its decentralized nature. It's not controlled by central banks or governments who like to print money and generate inflation in fiat currencies such as the US dollar or the euro. Cryptocurrency has been called digital gold by some investors who hold it because they think it will protect them from inflation. Potential for outsized gains. Buying cryptocurrencies creates the potential for large gains on your investment. Several cryptocurrencies have seen their prices skyrocket since first being introduced. These gains are the main reason people are attracted to cryptocurrencies, but the potential for price appreciation comes with significant risk. Growing number of coins. In the early days of cryptocurrencies, there were just a few coins that could be invested in, but the speculative interest has changed that. New coins are introduced regularly, and there are now thousands to choose from. Wide interest in digital currencies. There seems to be a growing interest in cryptocurrencies from investors, companies, and governments. Tesla holds Bitcoin on its balance sheet and briefly accepted the digital currency as payment before reversing course. El Salvador adopted Bitcoin as legal tender in 2021, though the International Monetary Fund has urged the country to reverse its decision. Increasing acceptance of digital currencies could be positive for investors. Cons of investing in cryptocurrency: extreme volatility. One of the most glaring cons of cryptocurrencies is their extreme volatility. Unlike traditional assets, cryptocurrencies lack a physical or tangible backing. Their value is solely determined by market demand and the sentiments of traders. This volatility leads to rapid and sometimes unpredictable price fluctuations, making it a high-risk investment. People have experienced substantial gains, but at the same time, devastating losses within short periods. Cybersecurity risks. Despite claims of being secure, the cryptocurrency realm has been a target for cybercriminals. There have been numerous instances of exchange hacks and theft of digital assets. Once funds are stolen, the decentralized and pseudonymous nature of cryptocurrencies makes recovering them an extremely challenging and often impossible task. Lack of intrinsic value. Unlike stocks or traditional investments that are backed by assets, earnings, or underlying value, cryptocurrencies lack intrinsic value. Stocks derive their value from the company's assets, earnings, and future growth potential. Cryptocurrencies, however, lack this fundamental support, raising concerns about their long-term stability and real worth. Regulatory risks. Regulatory uncertainty and risks pose a significant threat to the cryptocurrency market. While some countries have shown openness to cryptocurrencies, many governments remain cautious or outright skeptical. Regulatory shifts, such as bans or restrictions, can significantly impact the value and legality of certain cryptocurrencies. For instance, the outright ban of cryptocurrencies in China and the cautious approach of other nations, including the United States, have contributed to the market's uncertainty. These drawbacks highlight the speculative nature and uncertainties surrounding the cryptocurrency market, making it a risky and potentially volatile investment avenue. Investors need to carefully evaluate these factors and their risk tolerance before considering cryptocurrency investments. Pros of investing in stocks. Long history of solid returns. Stocks have a long track record of producing solid investment returns, with the S&P 500 stock index returning about 10% over the long term. Though stocks can be volatile in the short term, they have generally been safe to hold over long periods of time. Have intrinsic value. A stock represents an ownership interest in a company, and its value over time depends on the success of the underlying company. Companies own assets that produce earnings and cash flow for investors, creating what's known as intrinsic value. Accessible. It is easier than ever to invest in stocks these days, with many online brokers cutting trading fees to zero. You can invest in individual stocks or choose to purchase a diversified basket of stocks through an index fund. Index funds help keep costs low, and you can build a diversified portfolio even if you don't have much money to start with. Stronger regulation. Stock exchanges, brokers, and companies are all heavily regulated through various government agencies. Companies are required to provide certain information to investors through the Securities and Exchange Commission. No regulatory body is perfect, but stocks have been around for a long time, and there are certain important investor protections in place. Cons of investing in stocks. Volatile. When you hold a broad basket of stocks through index funds, stocks are less volatile than cryptocurrencies. Individual stocks can be more volatile, but typically less so than cryptocurrencies. Because of this volatility, stocks are best held as part of a long-term investment plan, so you have time to recover from any short-term losses. Lower potential for extreme gains. Broad stock indexes such as the S&P 500 likely have less potential for the extreme gains that can sometimes be found among cryptocurrencies. Stocks have returned about 10% over the long term, whereas it's not uncommon for cryptocurrencies to move 10% in a single day. Other considerations when investing in stocks versus crypto. Time horizon. Your time horizon, when you need the money from an investment, is a key criterion. The shorter your timeline, the safer your asset should be, so that it's there when you need it. The more volatile an asset, the less suited it is for those with a short timeline. Generally, experts suggest investors in risky assets such as stocks need at least 3 years to ride out volatility. Stocks are often volatile, but they tend to be less volatile than crypto. Individual stocks are more volatile than a portfolio of stocks, which tends to benefit from diversification. Stocks are better suited to investors who can leave their money alone and don't need to access it. Generally, the longer you can leave it invested, the better. Some stocks can be more volatile than others. For example, growth stocks tend to fluctuate much more than value stocks or dividend stocks. Investors may shift from more aggressive stocks, growth stocks, to safer ones, dividend stocks, as they need to tap their money, such as when they approach retirement. Cryptocurrency. While stocks are volatile, cryptocurrency is ridiculously volatile. For example, during 2021, Bitcoin lost more than half its value in a few months and later gained 100%. Such volatility makes crypto unsuited for short-term investors. Crypto is better suited to traders who can leave their money tied up and wait for it to recover. Think years rather than weeks. Cryptocurrency in the portfolio. Cryptocurrencies can add a level of diversification and potential for high returns to an investment portfolio. However, due to their inherent volatility and uncertainty, it's generally advised to allocate a relatively small portion, around 5% or less, to cryptocurrencies. This conservative allocation helps to mitigate risk. Although small, if the crypto market experiences significant growth, even this limited allocation could yield substantial benefits to your overall portfolio. Furthermore, limiting exposure to a small percentage safeguard against the potential catastrophic loss if the cryptocurrency market collapses or a particular digital asset becomes worthless. Should the value of your cryptocurrency investments increase significantly, you can rebalance your portfolio by reallocating some gains from crypto to more stable assets like stocks, thereby managing the overall risk. Stocks in the portfolio. Stocks have historically demonstrated strong long-term performance, making them a cornerstone of many investment portfolios, especially for those with longer investment horizons. If you're investing in individual stocks, it's crucial to conduct thorough research to make informed investment decisions. On the other hand, investing in funds, such as broadly diversified index funds like the S&P 500, offers a more convenient and less research-intensive approach while providing exposure to a wide array of companies and sectors. These funds have the potential for higher returns, offering a level of diversification by spreading the investment across multiple companies. Balancing the portfolio with a majority allocation in stocks and a smaller portion in cryptocurrencies, especially when aligned with your risk tolerance and investment timeline, can help manage the overall risk and potentially enhance returns. However, individual financial circumstances, risk appetite, and market conditions should guide the construction of one's investment portfolio. Regular monitoring and periodic rebalancing are crucial to maintaining the intended asset allocation and adapting to the changing market dynamics. The allure of crypto investments over traditional stock markets is undeniable, presenting unique opportunities and advantages for investors. As the crypto market continues to evolve and gain widespread acceptance, understanding the nuances and potentials it offers becomes increasingly crucial. Some cryptocurrencies have soared in price since being introduced over the past few years, but investors need to understand what they're investing in, instead of just rushing in because other traders are. If you decide to take a stake in crypto, consider how it fits with your own risk tolerance and financial needs. Investors can earn good returns without investing in cryptocurrency, and some investors, including legends such as Warren Buffett, won't touch cryptocurrency. In the dynamic landscape of investment, the decision between crypto and stocks remains a hotly debated topic. With its promise of higher returns, accessibility, and global acceptance, cryptocurrency has emerged as a compelling alternative to traditional stock markets. As you navigate this complex decision, understanding the nuances and opportunities in both markets is crucial. Remember, each investment avenue comes with its own set of risks and rewards. Stay informed, stay cautious, and make investment decisions that align with your financial goals and risk tolerance. Thank you for joining us on this thrilling journey through the world of finance. Remember to like, share, and subscribe for more insightful content. We will be back soon with a new video. Till then, keep supporting and take care.